Good afternoon, friends. First of all, wish you very happy 2025. This is the 2025 first Investor Connect webinar from AAA. I'm Sandeep Biyani, heading business development and sales for Alpha Accurate Advisors. Welcome to AAA Investor Connect. Friends, we entered in 2025 as an optimistic yet balanced in our outlook, cognizant that 2 years of good gains and broadening market suggest a lot of good news are priced into the growing number of stocks. After seeing a 21% CAGR by BSE 500 index over the past 2 years, we do see a possibility for index return to normalize towards the annual average. However, one should not judge market returns by indices, as we see enough opportunities across individual companies to maintain a constructive risk on stance. We believe 2025 is going to be a stock pickers year, as winners and losers would emerge across sectors. We re-emphasize on our view that what you don't own will be as important as what you do. As we had outlined in our previous AAA Investor Connect webinar, like last one was Be Bullish, Be Prudent, 1 and Series 2 as well. We continue to believe that active stock picking shall be instrumental for sustained alpha generation. Furthermore, the number of companies with returns below the benchmark has seen a stark increase as compared to last year. This symbolizes the need to increasingly focus on what to own and what not to own. To debunk this current market scenario, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, Rajesh.
Thank you. Thank you, Sandeep. Good evening, friends. Am I audible?
Yeah, very much. Rajesh, as there are many new investors or partners listening to you maybe the first time, I will request you to please start by throwing some lights on AAA investors, investment philosophy and style before you take on the topic. Over to you, Rajesh. Thanks.
Great. Thank you, Sandeep. Good evening, friends. First of all, I'm wishing you everyone a great 2025. May this year bring a lot of joy and happiness to each of you and your family members. Before I talk about market outlook, very briefly, maybe in about 4 or 5 minutes, let me talk about a little bit about our philosophy and our process. And before I talk about philosophy and process, let me also talk about why Alpha Accurate Advisors, something which is very important for all of you. The first important thing, compared to any other fund, at Alpha Accurate Advisors, I am founder and I am CIO, and therefore, there is no risk of changing guard. Second very important is, at Alpha Accurate Advisors, we have now completed 15 years doing this investment management. The existence, the longevity is something very important, and with 15 plus years, we are probably one of the oldest PMS firm in the country. The third important is, we are not into any other business like broking or wealth management and many more such things, which ensures that there is a zero conflict of interest. Fourth, very important is the competence. And in our market, while of course everybody loves bull market, market is always of two phases, bull market and bear market. And therefore, what not to do is equally important. But what not to do, you can learn only from your experience. And our team has a total combined year, 135 plus years of experience. We have navigated many downturns of the market, be it demonetization, be it COVID, be it Russia-Ukraine war, be it change of government locally or in US, be it a currency volatility, be it a commodity volatility. And since we have navigated all these different types of market very successfully, that gives the comfort and confidence that we can manage the various economic phases during the cycle. And last but not least is about our award-winning track record. Friends, in 15 years, our flagship PMS, which is called AAA India Opportunity PMS, has delivered 19% plus compounded annualized returns, 600 bits alpha compared to the benchmark indices. And our budding beast PMS, which is called AAA budding beast, which is a mid and small cap PMS, has delivered 32% compounded annualized returns since its inception, that is last 4 years. So that's the reason why Alpha Accurate Advisors, best of the competence, founder-driven fund management, and of course the best of the track record, the award-winning track record. Now let me quickly talk about our investment philosophy. Simple 4 words: protect capital and create wealth. Our investment style is something very unique, which is called cogility. It is a combination of quality and agility. Be quality conscious in what we do and be agile enough to get out of it. The discipline exit strategy is hallmark of Alpha Accurate Advisors, something very, very important because everybody knows what to buy, but people don't know that when to get out of it. So something very important is how we make sure that we are not only good in buying the stocks, but we are equally good in getting out of it. And that's why the cogility. In terms of stock selection approach, we have a 3M approach: market size, market share, and margin of safety. We buy the companies which are market leaders, supported by best of the governance and best of the management. But that is not enough. We buy market leaders provided they have an unleveraged balance sheet. It means borrowing should be very, very low. We prefer net cash companies. And on top of it, what we make sure is that they have 18 to 20% earnings growth. So we buy market leaders with the oligopoly, monopoly kind of a business characteristics with under leveraged balance sheet, provided they have 18 to 20% earnings growth. And once we buy, we monitor their valuation, we monitor their business cycle, we monitor their growth, and we try to, with a discipline exit strategy, we try to make sure that we deliver consistently compounded superior risk-adjusted returns. With that, let me share with you, coming to the market outlook, what is our view on market and how at Alpha Accurate Advisors we are positioned for this market. Please give me one moment. Please give me one moment. I hope my slides are visible. Sandeep, is slides visible?
Yeah, boss.
Perfect. Friends, as Sandeep has mentioned, from last 1 year, we have been talking about this theme. Our 2024 theme was be bullish, but be prudent. And I'm sure many of you would have agreed with me that 2021, 2022, and 2023, the 3 years of bull market, was kind of a wild bull market at times. And at times it was like throw the dart, make the money. But fundamentals are equally important. And that's why back in January 2024, we said that as we move into 2024, this throw the dart, make the money will stop somewhere and market will start rewarding the discipline. Market will start rewarding the quality. And actually, if you look at the market from September onwards, that momentum of just making money on daily basis, irrespective of the fundamentals of the company, it started changing. And as we enter 2025, we believe there's a huge money, there's a huge opportunity to be made, but provided you need to manage your risk well, because there are positives at the same time there are negatives, there are headwinds at the same time there are tailwinds, and as a fund manager, we need to make sure that we buy right business at right valuations and monitor their cycles. And that's why steering through cross currents. The most important when I'm talking about the cross current is the currencies. And I'm sure many of you probably would have question in your mind, how do we see market from here on? And the biggest villain somehow, at least in the media, has been the currency movement, particularly from 30th August to 17th Jan, where the currency in Indian INR depreciated by 3.2%. But let me tell you, friends, it is not that bad. When you look at this currency performance compared to the other economies, be it a South African, be it a Mexican, be it a Japanese, be it a Canadian dollar, be it euro, be it Swiss franc, be it a British pound, across this currency, in fact, Indian currency is the lowest depreciation in last 3.5 months compared to any other currency in the world. And this is something very, very important I wanted to draw your attention to, that our currency is much more better in terms of performance, despite all this noise, what is happening around Trump-related policies, tariff wars, and many more such things. And therefore, the first important thing which brings to our mind is that how are we positioned in a fiscal deficit? And I'm very happy to share with you that if you look at the India fiscal deficit policy, we are accelerating the fiscal consolidation, which has happened post-COVID. The country moved up from 4.6% to 9.2%. It required support, but unlike Western economies, our support was very, very measured support. It was a very, very prudent way of managing economy where the fiscal support was given, but in a very, very, I would say, judicious manner. And therefore, the fiscal deficit has already started reducing from peak of 9.2% to 6.4%, further to 5.6%. And we believe this year we will end at around 4.9. And I think that ministry will go towards 4.4%. And this is one of the best of the fiscal deficit with a country which is growing at 6.5 to 7% in real GDP growth. So our fiscal deficit is under control. That's basically what I wanted to highlight you, that in this global chaos, a lot of noise is happening across the world. The one important thing which you need to focus on and how is country's fiscal deficit. And on that parameter, India is doing reasonably well. In fact, India is doing much better compared to many other economies in the world. Coming to why we are remaining bullish, one is the macro, as I said, India is in a relatively much better position. At the same time, if you look at the gross capital formation as a percentage of GDP, if you look at this chart very carefully, we were 36% in 2007. Look at 2003 to 2007. And I'm sure many of you will remember that Sensex became 5 times in 5 years during this period, 5 times in 5 years. And then from 36%, it came down to as low as 27%. And from there, it started moving up. And we believe that we are in the second phase of this capex cycle. We are already 31, 32%. And I think over next 2 years, 3 years, 4 years, slowly, steadily, we will move to 34 to 35%. This is very, very important for the growth, because as countries start spending on more and more on the capex, the gross capital formation, it is a multiplier impact on our GDP. At the same time, what is also important is to revive the consumption. And if you look at the government social spending for the first 7 months, the numbers which are out, the rural spending of government, total social spending, has witnessed 25% increase. Now, remember one thing, post-COVID, the consumption was impacted the most. And that too, it was impacted mostly into the rural side of India. And government has rightly focused in last 7 months to handle and to address this issue. They will increase the spending on rural India. So on one hand, your gross capital formation is going to go up, and on the other hand, on rural social spending is also witnessing healthy increase. Both this combined means GDP growth is going to remain reasonably strong, 6.5 to 7%. And on top of it, you have a prudent fiscal policy. And that means that by and large, Indian economy will continue to do well over next 2, 3, 4, 5 years. When one talks about the very important point, the valuations, if you look at from 2014 onwards, that is a critical pivot point. Our valuation has jumped post 2014. And if you look at the last 10 years, average PE of India is about 20.4 times. And if you look at just 15 months forward, March 2026, we are roughly at 19.6 times. So now we are reasonably valued, and therefore we do not see a significant downside in Indian equity market. On a market level, at a broader level, we are reasonably positive on the market. We are bullish on the market with a 3 to 5 years view. The growth is going to remain reasonably good. Fiscal prudence going to be reasonably good. Our valuations are below 10 years average, and that means the margin of safety is in your favor. And hence, equity as an asset class will continue to deliver much better returns compared to any other asset class over next 3 to 4 to 5 years. Of course, there are phases of correction. Market will remain volatile, and one should not be worried about volatility. Rather, one should embrace the volatility. Keep a long-term view, because I always believe that when such kind of a scenario happens, when you see every day some noise factor is there, something happening globally, something happening locally, interest rate, inflation, currency, Fed rate expectations, Donald Trump related tariffs announcement, will they do 20 to 60% hike on China tariff, or will they do 200% increase in tariff on some items, or will they not do any tariff at all? There is just so much noise. The best thing is to avoid such noise and remain focused on the right amount of what I would say stock selection, because when country gives you opportunity of 6 to 7% GDP growth, it means 11% plus nominal GDP growth. We believe there are many companies in India which will deliver 18, 20, 25% kind of earnings growth. And once you have those kind of winners, if you identify them at right valuation, there is enough money to be made over next 2, 3, 4, 5 years from the Indian equity as an asset class. So that's on the valuation. But at the same time, as I said, then be selective. So while we are bullish, we are saying be selective. And why to be selective? And last time also I've shown one chart, and I'm repeating this chart again, that 2019 to 2024, and if you look at the profit growth and the market cap growth, there are many companies, roughly 32% of the universe, their market cap growth is significantly higher, despite their profit growth is very, very poor. Now, of course, this cannot continue, and therefore avoid the companies where you are going to see zero profit growth. Profit growth is critical for the market cap growth. In last 5 years, companies with or without profit growth both delivered market cap. Your mistakes were also rewarded, but I don't think next 5 years will be so generous. Mistakes will not be rewarded, they'll be rather penalized heavily. If you look at the ROE, very important factor when you select any company, there are many companies in last 5 years with a suboptimal ROE of less than 15%. They kept going up. Despite their ROEs were poor, their market cap went up by 28% compounding. Again, as I'm saying, that thing will not be rewarded. Discipline will be rewarded. Quality will be rewarded. High ROE is something very, very important when you do the right stock selection. And lastly, one important chart, the debt equity chart. There even the companies with a poor debt equity ratio, their market cap also went up. 14% of BSE 500 companies with a debt equity ratio more than 1, they compounded by 25%. I don't think this will continue over next 5 years. And therefore, be on the right side of the wealth creation, be on the right side of the companies, be it profit growth, be it ROE, be it debt equity, be it governance, be it balance sheet. We need to be on the right side of the companies. Good companies, good quality, good growth, under leverage, high ROE, that will be rewarded significantly better compared to the other extreme side of the market. In fact, post our last 6 months, what we've been talking about, and if you look at the decompose the BSE 500 returns across the different buckets, the large cap, mid cap, and small cap, there is one interesting chart which I would like to present to you. That if you look at of this large cap, 57% of large cap, they have underperformed the benchmark. 48% of mid caps have underperformed the benchmark, and 51% of small caps have underperformed the benchmark. So, as I'm saying, 2 years, 3 years, everything was going up. If you look at, for example, FY24, only 35% of large caps they underperformed. It means 65% have done better. Same thing is for mid cap, same thing for small cap. But the moment you look at from April to December, You break the last 12 months to first quarter and the last 9 months, the result is completely different. It is a stark contrast because the good companies are only delivering good market cap. There are many companies which are not being fundamentally solid. They are not being fundamentally sound in terms of either governance or profit size or debt equity or ROE. And those companies are started underperforming benchmark significantly. And that's why if you look at the last 3 months, there are many, when you meet many investors, they feel, कि market में कुछ हो नहीं रहा है, बहुत सारा stock नीचे जा रहा है. They are right, but what kind of stocks are going down? That's what one needs to see. So 57% of the large caps have underperformed, 48% of mid caps have underperformed, 51% of small caps have underperformed. So it means you need to be really very, very careful while doing the stock selection. And that's why be selective is the final mantra of 2025. If you look at one important thing to monitor the economy growth, how the capital goods sector is doing. And I talked about the gross capital formation where we expect a significant growth. And why do we think so? Because if you look at the average order inflow, the quarterly average order inflow, in FY21, it was 54,000 crores. That is moved to almost 1,339 billion, 1,33,000 crores, which is 2.5 times in last 3.5-4 years. So 21 to 22 we have seen growth, 22 to 23 we have seen growth, 23 to FY24 also we have seen growth, and we believe this momentum is going to continue. So everything is on track. Don't worry too much about the short term, some fast frequency data indicators which are a little bit showing the mixed signals, but we are not too much worried about it, and we believe that economy is on its course to deliver a reasonably good growth with the right fiscal prudence. With that, let me straight come to how our IOP and budding based what we are doing and how we are positioned. So friends, as you are aware, Alpha Accurate Advisors IOP, which is called AAA IOP, is a multi-cap PMS with a 15 plus years of track record. In terms of the sectoral allocation, this is the sectoral allocation. The banking is roughly 27%. Within banking and finance, we have been holding banking about 25 to 28% from quite some time. Within banking and finance, we own private sector banks. Our largest holding is ICICI Bank. Slowly, we inched up the allocation to HDFC Bank as well. Second bucket is NBFC. And here we have identified the number one player in second-hand commercial vehicle financing, which is, for example, Shriram Transport. We have identified around 1,300 rupees. Current price is 2,900 rupees plus. We identified number one company in gold finance, which is Muthoot Finance. Again, stock has been doing reasonably well since our purchase. In consumer durable financing, we hold Bajaj Finance. We increase our weightage on the housing finance. So in every sector, there are going to be winners and there are going to be losers. Like the banking credit growth is only 11%. But if you look at the housing finance credit growth, it is 17 to 18%. And we hold one of the company housing finance, which is growing at 22 to 24%. So we need to be at the right time, at the right place. Microfinance is one space which we have been avoiding from last 5 years. And most of these companies which are facing on the microfinance side, most of the stocks are down 30 to 40%. Again, that skill of avoiding of what not to do is extremely important. Sandeep is sharing his opening remark. What not to do will be something very important for 2025. Microfinance is one such thing which we avoided in last 5 years. And most of the stocks are down 30-40%, irrespective. They were so-called very good companies 2 years, 3 years back. Second is the software, which is about 11.7%. We have been actually underweight software sector earlier, but from last 3 months, 3.5, 4 months, slowly, steadily, we are increasing our weightage on software. We believe that the US economy is going to do reasonably well. Remember, software sector, we have increased our weightage earlier during COVID times. That time the growth was fastest. When Russia declared war against Ukraine, we reduced our software weightage from 14% to 7%. After that, the US economy went through very troubled time, and therefore the BFSI segment also got impacted. Most of the IT company stocks were down 30 to 40%. And post our exit, I think in March 2022, almost after 2.5 years, we have started adding software again. We believe that the sector will do reasonable growth after 1 or 2 quarters. The early signs are positives. Most of the management commentary we are hearing is talking about a better, TCV growth. That is the contract value growth, and that's basically the initial signs of the software sector. Capital goods remains one of our large sector exposure. We are extremely bullish on the capital goods space. In this capital goods, we do not have any company which is into pure EPC, zero irrigation, zero road, zero port, zero construction, no such companies. We are holding companies where technology is a moat, R&D is a moat. Like for example, Scott Transformer, one of our portfolio companies, the 75% market share. 7 out of 10 metro trains are run by Scott Transformer, supplied by that company. Similarly, that company's largest company into HVDC project, which is called high voltage DC project. They are one of the largest player and the biggest beneficiary of the global blackouts, the biggest beneficiary of the data center boom, the biggest beneficiary of the transmission of energy from Khavda of Kutch to Mumbai and Bangalore and Delhi, cities, because you require HVDC technology for that. So that's about our engineering. Fourth sector is pharma sector. Again, very interesting sector. We have exited that sector about 4 years back, and from last 7, 8, 9 months, slowly, steadily, we have been increasing our weightage in pharmaceutical space. In pharma space, what we like is more hospitals is what we like. We also like the CDMO space. In this space also there are a lot of positives which are happening. The CDMO and hospitals, these are the two better space to own within the healthcare. That's what we own here. In consumer space, we have a zero exposure to FMCG. Most of our portfolio companies are on the discretionary side. For example, Trent is our largest holding from last 4 years and has been doing exceptionally well. Auto and offensive is about 8.5–9%. Earlier, we've been holding about 11%. From September to November onwards, we have reduced our exposure to two-wheeler, and we also reduced some exposure to the two-wheeler related ancillaries, and otherwise we remain positive on the auto sector. So that's automobile and others. Power we continue to own about 3%. Specialty chemical is the new entry in the portfolio, again from last 3 months. This is the space where again we made huge money from 2018 to 2023. In March 2023, we made specialty chemical zero, and again we are looking at this sector with a more of a bottom-up opportunities and increasing the weight towards the chemical as a sector. And then there are others where we own, for example, exchange companies. We own the technology platform companies, the largest platform company on the digital insurance side. So we own few of such names. Our earnings performance for first quarter as well as second quarter has been extremely strong against the Nifty earnings growth of only 4% in revenue terms and 2% in profit terms. Our IOP delivered 16% revenue growth and 27% net profit after tax growth. Very, very strong performance despite challenging, or I would say little bit slowing macroeconomic environment. I always believe that input is more important than output. So how our portfolio's characteristics are, quantifying the quality is something very important. Is a multi-cap, 50% large cap, 50% mid and small cap. But we do not own any small company by profit size. All of our portfolio companies are reasonably large when it comes to profit size. 74% of the portfolio companies have 500 crores plus reported net profit after tax, and 91% of the portfolio companies have 100 crores plus profit. Most of them are under leveraged. Most of them are debt free. 47% of the portfolio is debt free. They all are market leaders. They enjoy strong pricing power, and therefore they have a high ROE, 19% ROE, and of course very, very high earnings growth, 23% earnings growth likely for the current year compared to Nifty earnings growth of 4%. And it is because of this, high quality with a disciplined exit strategy, what has been our performance of this product throughout last 15 years, more particularly how the product has fared during the downtime of the market. And this is the chart which shows that 15 out of 17 such volatile times, AAA IOP has outperformed the benchmark index. It means the fall is lesser compared to market despite very volatile times for the market. In terms of the CAGR performance, on 1 year basis, it delivered 25% compared to BSE 500 returns of only 15%. Very strong 1000 bips alpha on 1 year basis. On 2 years, 26.9%. On 3 years 17.5, 5 years 22.1, 10 years 16.5, and 15 years 19.2% compounded compared to benchmark returns of 13.1% compounded. As you can see here, across the different time cycles, 1 year, 2 years, 3 years, 5 years, 10 years, and 15 years, AAA IOP has outperformed the benchmark indices. In terms of the beta of the portfolio is less than 1. It means the low risk, very, very important for this year kind of a markets, when markets are going to be very, very selective, where discipline is going to be rewarded. The risk management is something very, very important. Our IOP beta is less than 1.85. Standard deviation is also less than benchmark. And of course, very strong Sharpe ratio. On AAA budding beach, the mid and small cap PMS. In India, there are 5,000 listed companies. Only 800 companies makes 100 crores plus profit. And of that, only 100 companies are called large cap. It means only 12% are large cap. And that means 88% of this universe, they falls into mid and small cap. And when we saw that the 88% are actually companies are big in terms of profit size, but market cap is small, that's why we launched AAA budding beach. The portfolio characteristics, here also it's very, very important that all our portfolio companies, they are large by profit size. 72% of the portfolio companies are 100 crores plus. Most of them are debt free or under leveraged balance sheet, very important. Probably AAA budding beach is India's only mid and small cap PMS, which is called mid and small, but we do not invest into any small chotu company. All companies are reasonably large. Average weighted market cap of this portfolio is roughly 31,000 crores, high ROE, low debt equity, market leadership, and very importantly, strong earnings growth are 4 important characteristics of our AAA budding beach portfolio. Just like IOP, AAA budding beach also delivered very strong second quarter earnings growth, 21% revenue growth, 28% net profit growth, compared to Nifty revenue growth of 4% and Nifty profit growth of just 2%. Economic environment was very, very challenging, but despite the slowdown in economy, our portfolio has done extremely well. In terms of sectoral allocation, our views remains the same. Allocations might be different compared to IOP, but by and large, the view remains the same. Capital goods is one sector, which we like the most, 16% of the portfolio. In pharma, we are more towards CDMO and hospitals. Banking and finance, we have increased the weightage to certain extent, but otherwise we are still only 12%. On consumer side, we own discretionary, automobile and auto ancillaries. Chemical is the recent entry. Software, we have been selectively adding to weightage. That's how the entire portfolio is positioned for. In terms of performance, AAA budding beach 1 year is 31.5 compared to BSE 400 26.3 and BSE 500 15.8. 2 years is 39.1% compounding returns, 3 years 26.5%, and 4 years 32.1% compounded annualized returns. Again, across 1 year, 2 year, 3 year, and 4 years, it has outperformed both BSE 500 as well as BSE 400 mid and small cap index. In terms of the current year financial YTD performance, the budding beach has delivered 32% returns compared to BSE 400 returns of 21.2 and BSE 500 returns of 11% and Nifty returns of only 7%. Again, selection is key. Be selective is a mantra for this year. In terms of beta, while it is mid and small cap PMS, beta is even less than BSE 500 index at less than 1 with a very strong Sharpe ratio. So that's it basically from my side. That's how basically both the portfolios are positioned for in terms of as a sectoral allocation. Just to repeat, 2025, we believe that last 10 years the government has done a lot of reforms. The pain has been taken in terms of putting up the right things. India's capacity to grow, in my view, has been increased multiple times in last 10 years. Be it a road infrastructure, be it a railway infrastructure, be it a airport infrastructure, be it a port infrastructure, be it a power infrastructure, be it a transmission infrastructure. The last 10 years, lot of steps have been taken. not only in terms of infrastructure growth, also in digitalization, and as well as in terms of making more and more support making India initiatives. Therefore, our capacity to grow has increased many times for next 10 years. When your capacity to grow increases significantly, that's a potential. And I'm sure there are a number of entrepreneurs in India within the listed space, 30, 40, 50, 100 of such entrepreneurs. They will take this as an opportunity and they will build their business model to capitalize on this opportunity to grow 20, 30, 40, 50% compounded over next 2, 3, 4, 5, 10 years. Let me give one simple example of a company called Dixon. I'm sure everybody probably knows this name. Dixon is the largest manufacturer of TV, largest manufacturer of washing machine, and now is the largest manufacturer of mobile phones. If you look at the Dixon revenue from 5,000 crores, it moved to 25,000 crores in a matter of just 5 years. 5 times in 5 years. Why? Because Indian government took right steps in terms of the PLI, right infrastructure, right turnaround time. Everything was right. But then some entrepreneur needs to capitalize on that opportunity to make it big. And Dixon has done it. I'm sure there are many more Dixons in the making. And if there are many more Dixons in the making, that's good news for investors and managers like us. And our job is to identify those entrepreneurs who can capitalize on this capacity of India to grow multifold over next 3, 5, 10 years. There are enough opportunities. And if you ask my personal view, in last 25 years, wherever there is a noise in the global market, currency, commodity, tariffs, the biggest risk what investors, or rather, let me put it, at times, the most investors, the common mistake is to be on the sidelines. कुछ नहीं करना है, देखते हैं. While it may help in the short term on 1 day, 1 week, 1 month basis, it doesn't help in the long term because the moment you are into sidelines, the dekhte hai kind of approach, all of a sudden market makes bottom somewhere there, and then you are not able to catch up the next bull run of the market. So I think we are in a structural bull market. India is a very, very sweet opportunity, and there are many companies which will make extra exceptionally high growth in this kind of a next 3, 5, 10 years market. So the wealth creation is going to be phenomenal over next 3, 5, 10 years. So that's my final message, that ignore the noise, remain focused, be selective. There's enough money on the table with only one condition: avoid the noise. With that, I would like to open up for question and answers, and please feel free if you have any queries. Thank you once again for hearing us very patiently. Thank you.
Just requesting all the participants, please post your questions in Q&A section, please. Thank you. Just waiting to the question queue assemble. Yeah, there's one question. Raj, with Trump taking in charge today, what's your view on Trump's influence on the Indian markets? How are you playing in this market condition?
Basically, most important thing is what not to do. Can one predict what Trump will do? Answer is no. What therefore one should avoid is companies and or businesses which are highly volatile in nature, where the fundamental has a lesser role to play. And that's basically pure oil and gas company, or for example, metal companies, and we avoid that space. Second, coming to the Trump related policy, whatever he's been talking from last 6 months. The one thing is very clear: the world is moving towards deglobalization. Deglobalization means the lesser global trade. Lesser global trade means you would like to import less, or you would like to reduce dependence on few economies from where your import is highest. And Trump has been very, very vocal about it of his against China policy. Forget the worst case scenario where we are talking about 60% plus tariffs. Even if you assume moderate scenario of 10, 15, 20% tariffs, additional tariffs on China, India by default gains out of it. Because while one in government in US wants to promote Make in USA, we all are aware that manufacturing system you cannot set up overnight. One, you require labor, and second, you want that labor to also work. These two things are not so easy in US. Their aspirations are different, their income levels are different, and they are not facing unemployment as a problem right now. So it is not that if you throw money, they are willing to work for you. They may not. The productivity levels are completely different in USA compared to the Asian economies. So if you want to reduce dependence on China in the longer term, the option here are two. One, you import more from countries like India, and or second, you also increase the production in your own country, which is US. But increasing production in your own country, US, will not happen overnight, and therefore it may take 3, 4, 5 years by the time the system gets established. In both this scenario, India is a net positive advantage India policy for next 2 to 3 to 4 to 5 years. And as a country, we need to make sure that we build our capabilities and we provide enough incentives to the domestic manufacturing to become a globally competitive force for the world market, particularly USA. Keeping in mind that there are few important things which basically will benefit. One is the engineering companies where the technology is a moat, where the cost efficiency is the moat, they will benefit significantly. That's not the only trigger for these engineering companies, but can act as one of the trigger for engineering companies. So we are holding few companies in a portfolio which can benefit from the export opportunity by their parent companies. So likewise, we need to do a little bit more deeper analysis. CDMO space, for example, is one space. Nothing much to do with the Trump, but I think the CDMO space, after seeing a lot of what I would say pressure on the discretionary budget on R&D side in pharma, now US economy is going to do well, and if the US economy does well, the pharmaceutical spend, which was a more discretionary on the research side of it, that will bounce back. And as that bounce back, the China, the dependence is huge. Even if you assume 1, 2, 3% movement from China to India in terms of CDMO related opportunity, it is enough for Indian pharma companies for 15, 20, 30% compounded earnings growth. Remember, 5 years back, we were talking about specialty chemical, that if a 1% shift from China to India can make a 20, 30, 40% additional growth. And that's what actually happened during the bad times when China was not able to supply. Same thing is for basically CDMO kind of companies. So I think we need to do bucket-wise research, bucket-wise analysis, and identify the right themes which can benefit from the Trumponics. So I hope I answered that question.
Yeah, thanks, Rajesh. In fact, the same questions came from Mr. Arpan Sethi as well again, and Mr. Bose Babu as well. I hope both of their questions also got answered. The next question from Mr. Srini. What is your view on defense sector?
Well, I think defense sector is a interesting sector. The opportunity is huge. The Make in India government intent is very, very clear. We would like more and more, Indian companies to participate in the defense programs. But there are challenges as well. The first important thing is there are very, very long gestation period. So something, for example, a company develops one product. That product has to work in Rajasthan desert, Garmi maybe it has to be successful, and it has to work in Ladakh. When it is at minus 20 degree also it has to be so minus 20 to plus 70. It has to work in both these extreme weather conditions. So it takes very, very long time from the approvals perspective. And therefore, defense we further segregate into multiple micro segments and say that how we can not only benefit out of it, but how can we reduce the lumpiness of the business, correct? How we can reduce the single order dependence company, because then it becomes like if the order comes, your company will do well, and if the order doesn't come, company stock price may go up, but then again it will come down, correct? So therefore, we have identified the right companies. For example, one of the companies into the largest defense electronics. They are the biggest company in the India. They by default, they get the bulk of the market share. They have their domain, their expertise. They are not dependent on only one order from one ministry. There are multiple orders, multiple execution, multiple programs that they run simultaneously. So that's one way to play. Secondly, we hold a company which is into forging and now also entering into defense, and that's a company which we added in our portfolio last month. And here again, being a private sector play, it's been the natural beneficiary and will be the as government does more of making India actual on ground programs and actual delivery of orders, which they will probably will come through over next 2-3 years. This company again will be a beneficiary of it. So defense net we are positive, but you need to be selective. 2022, 2023, they were the years of top down. For example, if you select defense, if you go right, you make 300%. 25 will not be like that. Even if you go right on your sector, your stock specific, you can go right or you can go wrong. So sector may or may not do that well. Companies will do well or they may not do well. So you need to be really very, very selective. The valuations are no more 2020 valuation. The valuations are factoring in certain amount of growth, and the delivery therefore is very, very critical. And hence, when we select the stock, we need to make sure that it is not dependent on one order. It is not dependent on one product. It is not dependent on one program. There has to be multiple programs, there has to be multiple products, there has to be multiple capabilities. You are not waiting for 10 years for your approval to come through, because if it's going to take 10 years, your stock price returns will become 0%, compounding for 10 years.
Okay. Thanks, Rajan. The next question is from Mr. Sharath. Would you advise a lump sum investor to put money in AAA IOP or budding beast, or if both? In what proportion? Time frame is 3 to 5 years.
Okay. Hi, Sharad. So basically, we have been saying from month of August, we have been recommending most of our investors to invest over a period of time, to do stagger over a period of 3, 4, 5 months, because we were expecting some correction. Luckily, in last 2 months, 2.5 months, some correction is already happening. In fact, if you look at the many stocks, 35% of stocks are down 20, 30, 40%. So 1/3 of the market is already down heavily. So I think good part of correction is already inside. Maybe it's very difficult to predict. Some correction might be still left. Who knows how much correction is still left? But I think good part is already done. So from here on, don't stagger too much. Maybe you can invest over a 2 months, over 2.5 months. Yes, one important event in between is 1st February is a budget day. Is an important day. There might be either good or bad news. Who knows? And market may react extreme positive or negative. Take advantage of it because that headline people will forget quickly and market quickly will get adjusted to. So maybe some lump sum depending upon your own asset allocation, or you can stagger over a period of 2 months, particularly if it is into budding beast. Between IOP and budding beast, which one? So budding beast, IOP is a multi-cap. Multi-cap is a less risky compared to mid and small cap. Mid and small cap has more volatility, and therefore mid and small cap typically one needs to have a little bit longer time horizon compared to multi-cap. Of course, with higher risk, generally they also have a higher earnings growth, and therefore the better returns potential with the long term. But the volatility also is going to be high, and hence you should have 5+ years of horizon when you are investing into AAA budding beast.
Great. The next question is from Mr. Vijay Thakkar. What can be the return expectations per annum for clients fresh investment coming today from a 3 to 5 years horizon into AAA IOP?
Hi Vijay. So basically, I always say that market is mirror of earnings growth. If you look at last 10-15 years, the Nifty earnings growth is around 11-12%, and Nifty delivered around 13% compounded annualized returns. Similarly, for portfolio, the portfolio earnings growth is something very, very important. Our multi-cap PMS, which is AAA IOP, has delivered 19% compound annualized returns for last 15 years because the underlying earnings growth has been 18% plus. Similarly, our budding-based underlying earnings growth has been 25% plus, and therefore it delivered 32% plus compounded annualized returns. So very, very important is to keep checking the earnings growth. Our portfolio earnings growth is significantly superior compared to the Nifty earnings growth. Who knows what returns? No one knows. But generally, earnings growth and market, goes together in the longer term.
Next question from Mr. Ujwal Dubey. Your view on Vesuvius. In fact, stock-specific questions, Mr. Dubey, we're sorry. Stock-specific questions we can't take on the public platform. Still, I'll request Rajesh to give some sort of throw some light on the refractories.
See, basically, refractories is a sector where there are only 2 or 3 players in India, and one of the portfolio company, Vesuvius, is one of the largest company in the world with a oligopoly kind of a status. In India, there are only 2, 3 players. Vesuvius again is the largest player. Within refractories, there are 2 types of important products. One is the flow control. Flow control basically is required for the higher end, the premium. When you make premium kind of a steel, you require that. Refractories are primarily used for the steel industry. The India steel capacity is currently 130 million ton, and there is likely to become 300 million ton over next 5, 7, 8 years. So one, the steel industry capacity is doubling, number one. Number two, earlier this industry had a 5, 7 players. In last 3 years, there has been consolidation. From 5, 7 players, it has now become 3, 4 players. So market share has improved. So market size is becoming big, first M. Second is market share, which is improving. And within that, the third important point, the product mix. The product mix is also improving as more premiumization happens. When each of these things happens, it means your ability to grow revenue and ability to grow profits is now much higher compared to last 10 years. If you look at the capex program of this company from FY12 to FY22, it has been almost very, very negligible. And if you look at from last 2 years and the next 2 years, this company has already committed 1,000 plus crores of capex, which is almost, I would say, 3 times compared to what they have spent in previous 10 years. This capex gives the visibility that the potential revenue growth which this company can deliver and the potential kind of steel capacity what this country can do it. Vesuvius being the forefront of the technology will be the biggest beneficiary of the new capacities which are coming up in this industry, particularly more on the premiumization. So that's basically, the Vesuvius. We are not recommending buy or we are not recommending sell. I would like to again re-emphasize here, whatever companies we are talking today, we might be holding for our PMS, our portfolio, and our process is agility, causality. We have a very, very disciplined exit strategy. If the company is not delivering in line with our earnings growth, we may exit the company tomorrow. So, please keep that at the back of your mind. I'm just giving you the fundamental view of why this company stock is already up about 50-60% from our purchase price. So, I don't want to comment further that whether it will be what we'll be doing, but I'm just giving you, why we should be as what we should be.
The next question is from Mr. Guru Prasad R. Sensex, which touched 85,000, went down to almost 76,000. Where do you think it will reach by end of this year? Your prediction.
Well, Guru Prasad, I think it's a crystal gazing, but let's put it in this way. The Nifty is currently trading at 19.6 times FY26, correct? Can Nifty go to 17 times FY26? Looks difficult, correct? So maybe 4, 5, 6, 7% correction may be possible. Do I expect 20% correction in Nifty? I don't think so. But still, can it happen? Who knows? It can happen tomorrow. But if I have a 3, 4, 5 years view, I'm okay. I will take that volatility and take advantage of it. If I'm holding cash, deploy more. If I don't have dry powder, it's okay. Still, you will get reasonable returns. Even if you invest on today's basis, you will still get reasonably high, returns compared to any other asset class from this equity.
Thanks, Raj. The next question from Mr. Anonymous at India. Sir, what's your view on travel and tourism sector?
Travel and tourism sector has a multiple sectors within it from the capital market perspective. One is, for example, airlines. Second is, for example, hotel. Third is the ancillary sector, for example, luggage. And then the fourth, which is called others. So there are multiple sectors within that. Airlines, we do not have any holding in airlines. Generally, we avoid airlines. Hotel, we normally generally don't invest unless until they become too cheap, because this is deep cyclical sector. Of course, last 3 years have been super years for Indian travel and tourism industry. But the valuations are already exceptionally high. So generally we avoid hotels. And that leaves the third sector, which is a luggage sector, which is one of our favorite sector. We have been holding the second largest luggage company for quite some time. It has been multi-bagger in our portfolio. We've been holding safari industry for a very, very long time. I think we bought in September 2020, and we kept, I think, up to June 2024, when the COVID wave down, lockdown 2 happened. That's where we bumped up the, increase our weightage to this luggage company. And the company has done phenomenally well. They kept gaining market share from both the players. Industry is also, consolidated a lot, and there are many positives and tailwind, also help the company. So that was one of our holding what we are having within travel and tourism. If you ask my personal view, that's the sector what we like, and we keep monitoring the different options available in that sector. And depending upon the growth outlook and depending upon the valuation comfort, we keep reviewing, what is to be done in that sector. But currently, if you ask my personal view, there is a heated competition in the sector. The number one player is not doing that great. The inventories are, if you visit any of the stores in the luggage stores, you still see huge discounts. It means there is still inventory issues to a certain extent, which is not a good sign in the short term. So we are monitoring the business cycles. That's what we do for each of our companies, potential company or the existing companies, and that remains true even for this sector.
Next question from Mr. Kayur. What is your take on renewable energy sector?
Good question, Kayur. Renewable energy again is a pretty large sector. There is a wind, there is a solar, and then the entire value chain. And then there is a very important part of that is the capital goods side of the renewable. So we are extremely bullish on the renewable energy overall sector, but at the same time, we are also equally aware that when you look at the value chain of renewable energy, for example, the module prices, yeah, or for example, solar cell prices. If you look at China, the prices have collapsed. So we don't know what will be the future prices of these, modules or the solar cells. Very difficult to predict. Technology is also changing. Is something very important which you should make a note of it. So what we are doing, instead of predicting, what will be the solar module price or solar cell price, anyway valuations have skyrocketed. We believe to play through the capital goods company. So if you want to bring the solar energy produced in Khavda, Kutch to Mumbai or Bangalore or Delhi, what do you require? You require HVDC. You require HVDC transmission. And there are only 2, 3, 4 companies in the world which can do this HVDC transmission. So one of our largest portfolio company, again, it is not a recommendation, Hitachi Energy or GE Vernova. These are the 2 companies what we own for different portfolios. They both are best positioned for HVDC transmission. So if the data center are going to be the power guzzler, if the world GDP growth compared to the world transmission growth, there is a deficit as per yesterday's one very big report which has come. The globally, what is the total transmission capex? It's been undershot. Global cities are going through the blackouts, first time unheard of in last 50 years. If you think, therefore, that what you require is more and more HVDC kind of a projects, then there are only 2, 3 companies which can do it globally, and both our portfolio companies are extremely rightly positioned to take advantage of it. Both these companies are doing capex globally, and I'm sure they are also going to be doing significant capex in India to boost their capacities, because there are only 3 companies in the world which can do this. So we are extremely bullish on, therefore, capital. In every business, we look at winner and we look at loser. And in winner, although there might be 5 opportunities, we keep checking what are the various parameters which will decide the earnings growth, and what will happen to that parameter if the China plays a very important role. So, for example, modules. It's better not to predict the price of modules because we can't predict it. So irrespective of the price, the HVDC project will benefit. Correct? So that's how we basically take the view. That's our view on renewable energy.
Thank you, Raj. The next question is, large alpha are made on having good allocation on high conviction stock. Why don't you increase the allocation on at least some of the stocks where you have high conviction? I guess that's where the differentiates the good fund manager and the great fund managers. And the subsequent question from the same attendee is that, secondly, what should be the sustainable exit multiple for capital goods sectors, given we have a good allocation in the sector? The two questions. First is more or less a why diversification.
Very good question. I don't see the name of the investor, but I think it's a very good question. I don't know. I think I'm sure the attendees in this room, they know a great fund manager called Peter Lynch, and he is the most celebrated fund manager globally. He outperformed the benchmark indices consistently for not 1, 2, 3, 5 years, but for decades. I'm sure everybody read Peter Lynch books, but I think people are not aware that how many stocks Peter Lynch used to own, and he used to own 2,000 companies. With the 2,000 companies, he was the best fund manager in the world. The moral of the story, what I'm trying to drive is, it is very well known that diversification reduces beta, but it is not very well known that diversification creates huge alpha. Your conviction and therefore the concentration, what you think which can happen because of your underlying assumptions, it can change dramatically. Think of it. One US FDA import alert and India's largest pharmaceutical stock can go down by 45%. Now, can you predict when US FDA import will? You can't. And you are the largest company of the country and still you go down 45%. So very, very important to know that India is a differently wired economy. This is the economy where there are 5,000 listed companies. Of the 5,000 listed companies, if you look at any segment, there are only 2 to 3 players, unlike Europe, where if you want to buy specialty chemical, you buy one company, you get 5 chemistries. In India, for every chemistry, you have only 2 companies, and that too only one plant, the H. Most of them has only one plant location. And therefore, when you want to play 2 chemistries rather than one, unlike Europe, which you can do by buying only one stock, in India, you need to buy 3 stocks because if you want to play 3 chemistries. Now, why don't you play only one chemistry? You can't, because you can't predict crude oil prices. You can't predict the derivative prices, irrespective whatever your knowledge might be have on your chemical and chemistry and specialty chemical. But ultimately, who are going to be the user segments? If it is, for example, ATBS, the largest user segment is oil and gas, and oil and gas depends upon the crude oil. So very, very important to understand that diversification creates huge alpha. We have been doing it from last 15 plus years. In last 15 plus years, we generated 600 bips extra returns compared to benchmark, 19.3% compounding compared to benchmark returns of 13.1%. That's a nice, good alpha of 600 bips. With that, I'm very pleased to share with you that not only we beaten the benchmark, but we outperformed the most other peer group, including the concentrated portfolios for last 10-15 years. In fact, we have been awarded as the top 3 PMS in India for 10 years by PMSCI World IIM Ahmedabad. We did that joint study, and that's the 4th year we have been awarded this performance. So believe me, diversification creates huge alpha. Your one hand, even if you go wrong, you can absorb the shock. Compared to 9% of one pharma company, USFD import alert, stock goes down 55%, you lose 5% on day one. So it helps you on both the ways. It helps you to reduce the beta and helps you to improve the alpha. Coming to the second question, the exit multiple for capital goods. Capital goods stocks are not only on exit multiple, but one needs to look at the incremental order book growth. And when you think the incremental order book growth is not going to work in your favor, not for one quarter, but for next 2, 3, 4 quarters, that means the growth will plateau down. And if the growth is going to come down, the PE will also compress. So first you need to have a ability to forecast the earnings growth and then the PE to that earnings growth. The most important is the incremental order book, the incremental new order flows. That's the first important thing which you need to monitor for the capital goods companies. to decide when to exit.
The next question is from Mr. Rishi Parsai. What do you think about the defense sector in the US? I don't.
Well, I don't know about US defense sector. I've not done that deep study in US defense sector. So I will know much comments to offer for defense sector in US. But if you are thinking that whether Indian defense companies there's the export potential, answer is yes. May not be to US, but maybe to Indonesia's of the world, maybe to the other Asian countries, like BrahMos and all these things we are talking about exports. India has also started exporting already from last 6-9 months. That can further accelerate because many other small economies they are looking at India because India is very cost effective, significantly lower prices compared to the US and the Europe. In the same time, it's a very effective defense programs. So that's basically the export opportunity side from India. But I have not much insights into the US defense sector.
Yeah, thanks. The next question is from Mr. Ankit Shah. Government is planning for an increased capex on railway sector. Can we see rally in the railway stocks?
Again, railway sector is pretty large sector. There are multiple subsegments within it. One important subsegment within it is a metro trains. And metro, Vande Bharat, bullet trains, all these are going to go up. And one of our large capital goods company has a 75% market share in metros. So as I said, 7 or 8 out of 10 metros are powered by Scott transformer. And that's basically one of the large capital goods company. There are many other stocks in railway which are into locomotives, and the locomotives order books are also going up, and they may also benefit. So don't look at just the capex number of railway. Please look at inside capex, which are the actual segment where growth is going to come through. That's important. Even on budget day, the macro numbers are not that important. More important is to get insight into each and every segment of where that expenditure is going to be. So depending upon where that number can change, you might see, rally or otherwise in the railway stocks.
The next question from Mr. CA Rakesh Mahajan, and I think this is already answered. Any update upon solar segments?
Solar, I already talked about that,
Yeah.
the entire value chain we already discussed. So I hope that answers.
Yeah, the next question from Mr. Gira. Do you invest in Adani companies? And if so, which companies and why?
Currently, we have a zero investment into Adani Group from last 10-15 years. So no investment as on now. We keep monitoring the different businesses within the group, and at any given point of time, if we like something, we'll have a look at it. But as on now, we have a zero investment in this group.
The next question is, what's your view on the beaten down sectors such as specialty chemicals and consumer?
Specialty chemical is one sector. If you remember, most of my investors, many of them I can see on this webinar. In 2018, we were probably the early one in India to buy specialty chemical. At the peak, we almost made 9% of the portfolio in specialty chemical. We made tons of money. We used to have Balaji Amines, SRF, Navin Fluorine, Vinity Organics, and many more such companies. By March 2023, as China was opening up, we decided to completely exit this sector. So we made by March 2023 zero exposure. After that, many of these companies' chemical prices started coming down, and therefore even stocks prices also witnessed a very healthy correction. In last 3-4 months, we believe that specialty chemical from here on, we are looking at more of a bottom-up opportunity. Top-down is still not that great. They are still going through some pain, but the bottom-up opportunities are emerging. And on a very select basis, we have started looking at specialty chemical sector. We already own right now 2 companies in our portfolio, and as and when we get more comfort, we will add to this sector.
Thanks. That's the end of questions for this webinar right now. Just requesting your final comments for the quarter to come. In fact, on the next week, there is a union budget as well. So your final comments.
So, well, I think, just to conclude, I think, Indian economy is on a reasonably good track. There is some slowdown which has happened in the first half because the government was in election mode and therefore there was a lesser capex. As we enter into the fourth quarter, I think the capex momentum is going to go up. And as we enter into FY26, capex will come back. That's number one. Rural spending, has been also increased in last 2, 3, 4 months, and therefore rural, which was the most impacted sector post-COVID, is also getting some relief. Better capex and the higher rural spending combined basically means better growth for the overall incorporate India over next 12 to 18 to 24 months. At the same time, the fiscal prudence is something very, very critical, and government has kept a very, very close eye on fiscal consolidation, which is a good sign for the economy from the FII's perspective. So net, volatility will be there, macro noise will be there, inflation and interest rate, US and India, crude oil, tariffs, China, India, confluence of factors which will keep market busy in terms of volatility. But as an investor, please make sure don't get disrupted by the noise, avoid the noise, be selective is the basically the message for 2025. I strongly believe that quality will be rewarded, discipline will be rewarded, active fund management will be rewarded, exit strategy will be rewarded, and therefore 2025 will be a year of active alpha fund managers to deliver reasonably good returns compared to the benchmarks. Thank you once again, everyone, for hearing us very, very patiently, and wishing you again a great 2025. The web link will be also available on our website.
Thank you. Thanks, Rajesh. Thanks, everybody. And even if you have any questions, you can reach out to us and let us know. We'll definitely try to answer your questions offline as well. Thanks, everyone. Again, wishing you all a very happy and prosperous New Year 2025. Thank you.
Thank you, guys. Bye.